things before we go through here. I've decided not to bother to print out these slides for two reasons. One, you can obviously just see what's coming up on the screen. I'll try and avoid death by PowerPoint, by the way, so it's not going to be loads of slides thrown at you here itself. What I'd just like to focus on today was effectively tax issues that affect people either coming up to retirement or people who are actually in retirement itself. So let me just get myself going, and then we can make a start. Power technology, there we go. Just a very brief introduction as for me. We move here. As I said, the presentation will be made available on the website later on this week. So if you want to go down, have a look at a copy, cure some insomnia, good bedtime reading, it will be there for you to have a look at later on. Now, when Clive asked me to do a presentation here, I was thinking, right, what am I going to talk about in terms of tax that we can condense in 15 minutes? Somebody's going to find relevant and interesting for them as they approach retirement or in retirement. So I focus on three broad areas. We know it's the old cliche thing in life, there are only two things you can guarantee. At some point the mortality will come, and at another point is the government in some way will pick your pocket and take tax off you. A very scary statistic. On average, it's been calculated when you go into retirement, the average pensioner will pay approximately an extra £6,000 a year in tax, and with lifespans extending, that's going to be at least for the next 19, 20 years. Within that, in terms of tax, by the way, we're going to focus on what I call direct taxes. So when you buy something nice, you go out to eat, you're going to pay VAT. If you happen to be a drinker, occasional otherwise, or smoke, you're going to pay duties. If you put petrol in your car, you've got duties. So whatever you want to call it, it's basically tax. There are things you can do to avoid that. Become a hermit, don't spend anything, and you'll save lots of money there. You'll probably have a pretty miserable life there, but that's one way to do it. So what I'm going to focus on is those taxes that are going to affect most of us on a day-to-day basis, what I call the direct taxes. Now, for our purposes, there are two forms. Most of you would have obviously worked through your life. You're at this time of your life, hopefully, you're going to be enjoying the benefits of your retirement. You may have accumulated some savings. Those savings will generate interest potentially. They are what we call subject to tax. That's what's called tax on your income, the stuff you need on a day-to-day basis. The other type of tax, for which there's two subgroups, is tax on capital. So, for example, stock, shares, the property that you live in, houses, attract either what they call capital gains tax if you decide to sell or give them to members of the family. And at that point, when we all pass away, there's potentially inheritance tax that's going to be hovering over there. What I will say, within reason, certainly inheritance tax is a tax that in theory can actually be avoided itself with a bit of planning. We're going to look at what I call housekeeping. So even if you're not necessarily a high earner, you need to make sure that the government, through the auspices like tax codes, that you are actually receiving the right amount of income, you're not being overtaxed, and it's unfortunately HMRC do not volunteer, by the way, when you pay too much tax. And a significant proportion of retirees do end up overpaying on tax and don't necessarily claim it back. You can go back up to 4 years, by the way, if you think you've actually paid too much previously. And HMRC, by the way, do make mistakes, just to point that out to you. We're going to look at the allowances, we're going to look at compliance. Now, the general rule is, the taxman takes the view, everybody in this room is assumed to know how the tax system operates with all its complexities. If you get it wrong and you get found out, you will minimum pay interest, you potentially be subject to a penalty, and you'll be slapped on the wrist, so to speak. That's metaphorical more than physical. The last bit I'm going to dip into is what I call estate planning. Probably the most valuable item for most individuals or couples is the family home they've got. And they might decide at some point what they're going to do with that family home there as well. To avoid the clutches of the family, the taxman I should say, to make sure it's passed on accordingly. Now can you check like this? Am I going okay? Does anyone hear me? Am I going too slowly? Fantastic. Right, just a bit here, don't worry about memorising these numbers, I'm not going to test anybody later on. A couple of things to bear in mind. Personal allowances, everyone in the UK and a European citizen is allowed, believe it or not, to have a certain sum of money called income every year free of tax. Currently, for the year that we're in, it's £9,440. Allowances are now based on the date of birth, by the way, as opposed to what it was at the beginning of the year. The government, in all its wisdom, have decided that if you manage to survive beyond a certain age, you used to get additional allowances. Those are effectively being frozen. So if you happen to be born effectively, what are we talking about? The allowances pre-38, you're going to get the higher 1066. It's now going to be frozen, so everybody is going to be treated as a single person, irrespective of age threshold. Just a few headline numbers there. If you happen to be born before 6th of April 1935, one person in that marriage or civil partnership, so you can have a 20-year-old and a 65-year-old, you're entitled to an extra £1,791 a year, a reduction against your income. So it's a little bit, but it's there. It's estimated about 4.41 million people have been worse off in the tax regime over the last 2 or 3 years there itself. And I suspect it's likely to get a little bit tougher. Okay, tax housekeeping. Now, for those of you in receipt of state pension, be aware it's classified as taxable. And what that means is, if you have other income, so you've got some deposits on savings, you get interest, you may have another property that you're renting out. You may have a part-time job, for example. If you aggregate all those together and it goes over a certain level, you are subject to tax. Now, if you've got pensions through your previous work, or you've taken out a personal pension here, normally the pension provider will treat it as though you're employed and they will take tax off its source there as well. You need to check the numbers that you get on that coding notice are actually correct there as well. If they're incorrect, and I've come across quite a number of situations where people have got the wrong tax code, overpaying in tax is not for the revenue to say you're overpaying. Have a check at it. It's a relatively simple thing to check out. If you think you are effectively overpaying, let's have a look at some papers. There's 3 forms there that I've mentioned. There's one that's called I-85, so if you happen to be on a modest income and you've got a little bit of savings income and it's below a certain level, it's about 9,500, you can apply to the building society or the bank not to take tax off at all. And that's what they call the form R85. Some banks and building societies are quite obstructive, by the way, but it's your right, you can claim to have it without tax taken off. If, however, you have had it taken off but you think you've overpaid, keep it simple. You don't necessarily need to employ an advisor. So I'm doing myself out of a job here. These things, they're a good helpline. Age UK have a very good package. Lots of support agencies, which, ourselves included, are quite happy to do these things to support you. R40 is a simple form where you claim the money back from the tax authorities. Be aware, by the way, in my experience, they tend to be quite protracted sometimes. Don't expect it to come back by return. But, be persistent, and there are other claims. Other things, if you're in a situation where you're disabled, certain items that you buy in to adapt your kitchen, your bathroom, for example, are free of VAT, so you can apply to the builder not to charge you VAT. And a current rate of 20%, that can be quite a saving there as well. Compliance. What that means is, if you have got income that hasn't had tax taken off, technically speaking, you need to declare it. When I say technically speaking, that means if you don't, you've broken the law, as far as that's concerned. Very dramatic, by the way. If you don't do that, it's actually classified as money laundering, which is a criminal offence as well. So, I know that sounds a very dramatic term to do. Remember, if you're uncertain, contact somebody appropriately just to check what your status is. Just to run through in terms of income. Now, believe it, some of it is actually free. So you can get certain types of income which is exempt from tax completely. Unfortunately, you'll find the list is not that exhaustive. Typically, things like ISAs, great for while you're alive, free from income, but obviously when you pass away, it potentially becomes part of your estate. So if it doesn't get you while you're alive, the taxman may grab it when you pass away. National savings certificates, premium bonds, which I believe now that they're actually now changing the rules on that. Saves you earn schemes are free of tax completely. The capital element of the purchase life unity. So there are some things still free. Unfortunately, it tends to get less and less these days. Some items that somebody will take tax off at source. Bank interest or building society interest, again, 20% will be deducted from that income. Most building societies will do it automatically, so if you don't think you should have it taken off, apply for the form and make sure you receive it gross. Other things, this is direct assessment. So if you have any of these sorts of income, it's up to you in theory to report that to the authorities. Now, there are still some benefits. Now, do you want to emphasise something? It's all very well talking about numbers and what you should do. Please don't let the tax decision wag the tail of your lifestyle. Ultimately, you still need to live. You need money to, obviously, on a day-to-day basis and for savings. So you need to really think about these things logically about how it balances out. If you have a small part-time business still, even though you might be retired, that's subject to assessment. If you have a largish house or a house which effectively is just yourself or you and your partner, and you're not averse to the idea of renting out one of the rooms here, you can have up to just over £4,000 a year free of tax. And it won't affect the tax position of your household either. So when you sell your main property, it's normally free of capital gains tax. If you rent a room in that house and you occupy it as well, you can have £4,250 tax-free, and there's no even forms to complete there as well. If you leave the house, however, that's subject to tax. So again, like all these things, the devil's in the detail. Now, it will affect some of us. Capital gains tax. So typically, you may decide to effectively give away some property that you might have accumulated. Now, two things. You've got to be classified as a resident or ordinarily resident in the United Kingdom for capital gains tax to apply. What this means is, if you fancy a life in the sun and you've built up a portfolio and you've got some shares maybe, you've got some property, the easiest way to get rid of those properties and avoid tax, leave the UK, live abroad for at least 5 years, sell all your properties and everything is tax-free. You can come back to the UK after the 5th year has elapsed and you won't be subject to any tax. Probably sounds a bit dramatic, by the way. You are allowed some time in the United Kingdom, by the way, but you're not allowed to reside here as such. I won't go into the residency rules as such, but very crudely, if you spend over 183 days, you're a resident. If you spend less than 183 days, there's some weird tests that they've changed this year. You're talking about 20 days a year. If you think you can avoid the wet and the cold of the UK for 20 days, then that's a nice way to do it. A couple of general points. The rates for capital are less than they are for income. Some very simple measures that I would suggest. If you're on a civil partnership, if you're married, think about what they call equalising your estate. So if one of the parties has got all the savings and the other party hasn't, if you're not working, think about equalising it. You can transfer them amongst each other completely free of tax. If you own shares or you own other assets, you can give them to your partner, and again, that will be free of tax. The only domestic arrangement I would suggest is assume that your partner's not going to run up with your complete life savings, just to make sure. The most dramatic way to avoid capital gains tax is when you're dead, which obviously is not much good to you, but obviously that will be subject to inheritance tax when you do. So there is a little bit of a trade-off. You are allowed just under £11,000, by the way, for each year, free of tax, of capital, where you can. I'm not an investment expert, but there are certain savings products which produce more capital growth than income. They may benefit you financially. Okay, the one that I would say on paper is potentially avoidable. Now, for the vast majority of people, this may not apply. But if you happen to own property, what tends to happen is you start your working life, you acquire a property, you work hard, you start paying off the mortgage. As you get to the more sort of mature end of things, you find that mortgages become less, you've got more equity left over in the property, which means potentially, that might put you in a position that you're going to be subject to inheritance tax. For UK people, if you happen to be born here and basically going to die here and all your roots are here, you're going to be classified as UK domicile. Everything you own in the world, wherever it's located, is subject to UK inheritance tax. The first 325,000 is fine. Now it's called NRB, that's a posh way of saying nil rate back. And it works on what's called accumulation principle. So if I take a very simple example, I've got a large house, I've got cash in the bank, I've got some ISAs, I've got some other savings products, I pass away and it's worth £500,000. Now, assuming I've got no surviving spouse, that £500,000, 325 will be free, the rest of it will be taxed at 40%. Now, there are ways that one can avoid it. The easiest way to avoid it is to spend it, use it, and make sure you've got sufficient enough until that final day there itself. If you feel you want to wish to pass it on to somebody, you've got two types of transfer. You can give something to an individual, like cash or property, and it's classified as a pet. Now, it's not a pet in the domestic sense. It means potentially it may be free of inheritance tax. The potential bit is you've got to survive that gift by 7 years there as well. Minimum period of time is 3. So if you can survive at least 3 years, then you'll start getting a reduction in the tax bill. Now, I don't know if this is a true story, but when I studied tax many years ago, I was told of a story of a couple who in the UK, very wealthy. Unfortunately, the husband passed away, and what they did, they put him on a life support machine. They kept him on a life support machine for about 4 or 5 years, so you can actually click in to the 7-year survivorship rule. So if you've got a valuable estate and you've got access to a life support machine, that is one way to potentially avoid it. I would certainly recommend it. The government, in their infinite wisdom, have frozen the bands, by the way. So 325,000 is going to remain at that level up till 2017-18. All of us practically know with inflation and everything else going up, it's going to erode the value of what's left over. So far more people will be called by IHT. Let me just mention a couple of other ways that we can avoid this. Now, if you give anything away while you're still alive, which is normally one of the recommendations, effectively, no tax is charged while you're still surviving. Anything you give to your spouse, again, is free of IHT, so there's no trigger there. Now, if you happen to pass away within 7 years of the gift, then potentially all those gifts will be revisited and potentially you may be struck with an IHT liability. Obviously, once you pass away, there's a 40% rate that applies, and generally speaking it says, what have you got that's worth anything? What debts do you have? Let's do a seesaw exercise. Anything left over is the value of your estate itself. And remember, that's assets that are located overseas as well as the United Kingdom there itself. Now, there's something called GWR. Now, typically, the biggest single asset for most people is the family home. Now, I'm going to mention in the last couple of slides about potential things to consider, that if you have got a family home and you've got children and you wish to pass that on to your children, what's the way that they can get hold of that and still avoid an IHT bill? So I'll just outline 2 or 3 methodologies that we can go for. GWR stands for Gift with Reservation. And basically what that means is, if you give something to somebody, it means you've got to give it to them, you still can't retain a benefit. Typical example, I've got a family home, I give it to my son, but I carry on living in the property, rent-free. That's called a gift with reservation. And what happens is, if I give the house away today, and the house is worth 100 grand, and I live in it rent-free, because I've given it to him, I survive. When I pass away, it's the value of the house when I die that goes into your estate. So if you're thinking you're avoiding IHT, you're probably making the problem slightly worse. The last bit on the slide, by the way, if you pass away, your spouse passes away, if they haven't used any of the banding, then they can transfer it over to you, or they can transfer a proportion over it. So in theory, you can have £650,000 exemption when you pass away if you're in a civil partnership or married. This 7-year period, always think of it as a clock. So I start now, I start giving things away. I give cash to relatives, I give property away, etc. Make sure you retain enough by the way to live and have a good standard of living. Effectively, if I can survive a 7-year period, I can start giving assets and money away there as well. I wish I told my parents this many years ago, and I would have been a bit wealthier than I am now. Now, effectively, I'm not going to go over the actual detailed calculations, but effectively one tactic is to give it away and to retain no actual benefit in it yourself. Now, there are some things you can give away now, by the way. Now, what I would strongly recommend, if you think you're likely to be in this situation, and I'm going to outline some gifts that you can make which are free and drop out your estate, it's records. That's the most critical thing here as well. So if you think you've given gifts away, if you think you're entitled to some allowances, what the reality will be, make sure you've got evidence to back up what you're saying. itself. And obviously in that unfortunate demise when somebody passes away, the last thing you think about is where are the records and where are the evidence. So I would suggest you need to think about that probably while you're alive. Now every year you are allowed to make a gift of cash or equivalent of £3,000. And that's free of IHT. It will drop out the estate. If one of your children is about to get married, in consideration of that marriage, if you're feeling generous and you've got the money, you can give them £5,000 each parent, and that's free of IHT as well. Grandparents and other relationships, it drops down from 2.5 to 1,000. Now this is what I think is probably a little unused. It's what's called normal expenditure out of income. Now 3 things need to happen here. Typical example might be, you decide to set up a life assurance policy in the name of your children. Write it under what they call trust, so you don't actually benefit from that. And if you pay the premiums, assuming you've got that affordability level, then that does not become part of your IHT estate. When that day happens and the life assurance policy matures, the beneficiary, the children, will receive that free of IHT and it will drop out the estate. And again, there is no limit. The key thing is, it's got to be regular, so making a premium payment, say every quarter, every 6 months is fine. There's got to be effectively such that you've got a normal standard of living that you can still maintain, but unfortunately it's got to be made out of income. So if most of your money is wrapped up in property and assets, probably this one won't really count for anything. You've also got something called a small gifts exemption. You can make small gifts up to an individual up to £250 per year. All of them are suggesting start giving things away. There are some what are called death reliefs here. Basically, if you've got shares of a certain magnitude, a certain type, typically unquoted business shares, not investment companies, if you hold them for at least 2 years, they drop out the estate and they're IHT free as well. Right, shall we look at the last 2 or 3 slides here? As we said, gifts with reservations. Now the revenue had this idea going back to 2007, 2008, that give the family a home away, you're still living in that, they thought that was a little bit naughty. So there's 2 basically sledgehammer bits of legislation they've introduced. One's called give with reservation. So if you give something to somebody, but you still benefit from that, it can't be a gift. It's the same logic that's applied if you make donations to charity under what's called gift aid. If you give money to charity, you should not expect anything in return. Otherwise it's not a gift. Now, effectively, if that complies, then that asset remains in your estate. Now, there's another thing here. It's what's called pre-owned asset legislation. So I've got a chunk of cash, I mortgage my I've got a chunk of cash, I give it to my son, and I say, go off and buy a house. At some point later, I move into that house. Unfortunately, the revenue will still see that you benefited yourself from that gift. So, again, if time is on your side and you've got the surplus money, give them, you can quite easily, say your son can buy the house themselves, you can move in and you can start to furnish the property and help them with the maintenance of the property, that's fine. There's no pre-owned asset regime that kicks in. The simplest thing to do, if you want to give a lump of cash to somebody, they buy the property, wait 7 years, then you can move in, then you'll be fine there as well. Whether you want to wait 7 years to move into a different property, you know, is a practical consideration. Okay, I'm just going to finish off now with about 3 or 4 slides on what I call the family home. For me, there's probably 3 main options. Self-made residence, most people tend to downsize, give the cash, bracket, spend it on yourself. There as well. That's one way. The cash itself is classified as a pet, which means no IHT, no capital gains tax, but you've got to survive 7 years for it to drop out of your estate completely. And there's no what's called gift with reservation. A less common tactic, by the way, and again you must check with things like legal advice. You sell the property to, say, somebody at market value, and then you rent it back from them. Obviously that means you're going to have the funds to afford the rent on the property. There's going to be issues over security and tenure. Unfortunately, all the time that I've been working my profession, I've seen families fall out, brothers and sisters fall out when it comes to money. So, you know, family bonds aren't always tight, especially when money comes into play. So, you know, you need to handle this very delicately. You can give the property away. Give the property, If you want to still reside in it, the most common tactic is, if you want to call it that, is you pay a commercial rent on the property. If you pay a market commercial rent on the property, you cannot be seen to be getting any benefit out of it, so it will drop out of the estate potentially. A slightly more again, and it's all about risk. If you're what I call risk cautious, you've got to a stage in your life you don't want to take excess risk with the money that you've accumulated, this may not be for you. Everybody has slightly different attitudes to risk. So what you do, you mortgage the property, the proceeds that you've got from the mortgage, you invest in something called AIM shares. They're a particular type of shares. If you can keep them for at least 2 years, they become IHT exempt there as well. So again, that's potentially something. You can give the property and you just relocate to rented accommodation. Okay, last couple of slides. Keep your main residence and you can co-own it with members of your family. Now on this one here, HMRC, the suspicious people that they are, normally only accept this type of co-ownership arrangement. So that's where you occupy the property and other members of your family also co-own part of the property there as well. You'll be known as what's called tenancy in common, and it's not seen as a gift with reservation or pre-owned asset. So again, co-ownership, what you could ask yourself though obviously is, depending on how old your children are, how long they left home, is that something you can see yourself doing with living with your children after all this period of time? Much as I love my son, I don't think I'd necessarily want to share a house with him. He's certainly from my age of life anyway. I'm just going to mention wills briefly because we've got experts in the audience who know more about wills than I do. In countries like France and Germany, if you pass away, there are what are called forced heirship laws, and they dictate how your money is to be shared. In the UK, if you make a will, the will survives, pretty much divorce, separation and everything else, and that dictates how the estate is to be divided. If you die without making a will, of which quite a number of people do, there are specific rules as to how those assets are being divided up, and it won't necessarily reflect your personal intention while you've still been alive. One good thing is though, you can, if you've made a will, the will can be changed within 2 years of your passing away if it's a tax issue that's come out of it, assuming all parties agree. That's what we call the deed of variation. So if all the beneficiaries agree, the will can be redrafted, after you've passed away. And again, normally that's done for IHT purposes. Just to mention at the bottom, if you're in that situation you do have IHT, I was talking to Clive earlier on, you can take out insurance, but it can be quite expensive. So it's really, it's a trade-off between what can I avoid and minimise, and what would it cost me to protect myself otherwise. Revenue will allow instalments to be made on the IHT. Obviously, if you've passed away, it won't be your consideration, it will be the remaining people who are on. As I said, we talked about term insurance. I'm just going to mention it briefly, by the way. This is a topic all in its own right. If you've got a reasonable size estate, you might consider something called trust. Now, trust for me, effectively, is if you've got a situation where you've got family members who might be disabled, or you don't trust your children to do what they should do sensibly with the inheritance, you may set up a trust. And a trust is set up for two main reasons. One is a tax saving, potentially. The other one is if you don't actually trust the survivors to look after the money themselves. So if you've got children who are quite young, you may think they'll spend the inheritance gambling or going out and they'll spend it all in a year. A trust can influence and dictate how those resources should be used there as well. That's pretty much where I am. So thank you very much. I don't know how you do questions. Do you want to do them at the end or who now? Are there any burning questions anybody's got to ask?
When you mentioned regarding the actual trust situation,
yeah.
What, obviously, if you've got people that you're going to give money to,
yeah.
How is the restriction on them then? Who's got the say on the restriction?
Well, when you set up the trust here, the trustees who actually manage that on your behalf, depending on what the type of trust is, they will be the ones who will dictate how those resources are to be used. You have an expression, tell them how you want those resources handled, and depending on the type of trust you set up, will shall we say, influence the level of input that an outside has. But you'll have executors who will manage that on your behalf. So you might say, for example, I don't want anyone to touch any of the money in that trust until they get to the age of 25, until they've done that. You may not want people to draw down certain types of income until they get to a certain age themselves. And that can be an expression of interest.
But that could also be put in a will.
Oh yes, very much so. Very much so.
Couple of questions.
Yes, I
No, I'm giving my money away now while I'm allowed to animal charities.
Okay.
So, by the time it's my turn to go, there won't be that much money left anyway. As long as I've got enough for myself, but I'll give it to them. And this thing about sharing money, now, we don't live together, but could I say to him, right, well, I'll give you a half share of the property, although you don't live in my property?
Can I be very personal, madam? Are you two married or?
No, we're just very, very good friends.
It's very good friends, okay. Now, on the grounds that, because if you're married, it has a particular status there, so as far as tax law is concerned, you can gift half your value, estate, whatever, to your friend.
Even though we don't live together permanently? No,
because all that will be classified as what's called a pet, okay? So you might say, right, I've got property, I've got some spare money in the account, I want you to have half of it. You can transfer that across. Potentially that drops out of what they call your estate, what you've got yourself. If you survive that gift of 7 years, minimum 3, then the tax bill will be reduced. So you don't have to live together for that to constitute as a gift. One thing about the charity, by the way, just to mention, if you give away more than 10% of your estate to charity, and when you do pass away, you'll be subject to 36% on your estate. So actually giving to charity not only reduces the rate that you'll pay, but also gifts to charities are exempt from IHT.
Oh right, lovely.
Yeah, so not only are you doing a good thing, you're also doing a bit of tax saving there as well.
Oh great, didn't really know how we're doing that.
There you go. No, but no, you weren't motivated by the tax reasons, you're motivated by what you feel is the right thing to do.
Yeah.
Yeah, good.
Oh, thank you very
No
much.
problem at all. Any other questions? Okay, well thank you for your time. Okay, I'll pass over to Clive now. Okay.